In a world increasingly defined by digital assets, the tectonic plates of the crypto landscape are shifting, particularly under the influence of political dynamics. Recent developments in the United States, driven by the newly elected President Donald Trump, have sparked significant interest and concern within the cryptocurrency market and beyond. As the Biden administration's cautious approach to crypto regulation gives way to more favorable policies, the implications are reverberating across the globe, including in India, where officials are reassessing the country's stance on digital currencies. Amidst this backdrop, Indian government officials have indicated a thorough review of the nation's cryptocurrency policies, influenced by the evolving global landscape. A senior official mentioned that the country is closely observing the favorable crypto regulations emerging from the U.S. and the potential impacts these could have domestically. This review has led to delays in the release of a discussion paper on cryptocurrencies that was anticipated last year, highlighting the importance of international regulatory trends on India's policymaking process. The U.S. Federal Reserve has also signaled a significant shift in its approach to cryptocurrency. Chair Jerome Powell recently opened the door for banks to engage more actively with digital assets, stating banks are perfectly able to serve crypto customers as long as they can understand and service the risks. This statement aligns with the broader trend of Wall Street's increasing acceptance of cryptocurrencies, evidenced by the launch of several spot Bitcoin exchange-traded funds ETFs and the growing interest from major financial institutions like BlackRock. However, this favorable shift in sentiment comes at a time when fears of a potential market crash loom large. Following the surge in Bitcoin's price to nearly $110,000, driven by news of Trump's crypto initiatives and his plans to integrate digital assets into the financial sector, some analysts have warned of an impending financial crisis. Notably, Robert Kiyosaki, author of Rich Dad Poor Dad, cautioned that the looming tariffs imposed by Trump on imports could trigger a downturn in the crypto market, suggesting gold, silver, Bitcoin may crash. Good. We'll buy more after prices crash. Trump's administration is not just reshaping regulatory frameworks, it is also intertwining traditional finance with the crypto sector. The launch of Truth.Fi by Trump Media and Technology Group, which plans to invest heavily in cryptocurrencies, signals a new era where digital assets are acknowledged by established financial players. The recent repeal of Staff Accounting Bulletin 121 by the SEC, which previously made it cumbersome for banks to hold crypto, further paves the way for greater integration of cryptocurrencies into mainstream finance. Industry experts anticipate that these developments will lead to a broader acceptance of digital assets as a standard investment class akin to equities or commodities. Jeffrey Neuberger, head of the blockchain group at Proskauer, noted that this integration could foster a greater level of trust among investors and financial institutions alike. As these changes unfold, the global cryptocurrency landscape is poised for a transformative period. The evolving regulatory environment in the U.S. and its ripple effects on countries like India highlight the interconnected nature of crypto markets. Observers will be keenly watching how these dynamics play out in the coming months, particularly as the world grapples with the implications of increased financialization of digital assets. Looking ahead, the implications of these developments could reshape not only the regulatory landscape but also the very nature of investment in cryptocurrencies. As the dialogue around digital assets continues to evolve, stakeholders across the globe will need to navigate the complexities of a rapidly changing environment, balancing innovation with regulatory oversight. The future of cryptocurrency is not merely about technology but increasingly about the political and economic frameworks that govern it in a rapidly evolving cryptocurrency landscape. Recent developments signal a significant potential turning point for Bitcoin and the broader digital asset market. Following Donald Trump's victory in the U.S. presidential election, Bitcoin surged to unprecedented heights, nearly reaching $110,000. However, this optimism has been met with new concerns over a potential bubble, as highlighted by industry experts and market analysts. Federal Reserve Chair Jerome Powell recently declared that banks are now permitted to offer services related to Bitcoin and other cryptocurrencies provided they can adequately manage the associated risks. Banks are perfectly able to serve crypto customers as long as they can understand and service the risks, Powell stated during a press conference emphasizing the need for a cautious approach. This marks a notable shift in regulatory sentiment compared to the previous administration, which had adopted a more skeptical stance towards digital currencies. As Wall Street giants, including BlackRock, have increasingly embraced cryptocurrencies, especially via spot Bitcoin exchange-traded funds ETFs, the financial establishment appears to be normalizing Bitcoin and its counterparts. Powell's remarks not only reflect an openness to cryptocurrency but also come amid fears of a looming financial crisis as forecasted by some seasoned traders. Meanwhile, Trump's administration has begun to adopt cryptocurrency more actively, evidenced by the former president's ventures into non-fungible tokens (NFTs) and the promotion of a national Bitcoin stockpile. Trump's recently announced tariffs on imports from Canada, Mexico, and China have further stirred the pot, with financial analysts like Robert Kiyosaki warning that such actions could precipitate a crash in various asset classes, including Bitcoin. Kiyosaki noted gold, silver, Bitcoin may crash. Good. I will buy more after prices crash. In addition to these regulatory shifts, the U.S. Securities and Exchange Commission (SEC) has indicated plans to create a task force aimed at establishing a clear regulatory framework for cryptocurrencies. This development, announced by acting SEC Chairman Mark Uyeda, is being viewed as a potential catalyst for renewed investor confidence. The prospect of clearer regulations may help mitigate the uncertainty that has long surrounded cryptocurrency investments and could entice a broader range of investors to consider Bitcoin as a viable asset. Following the announcement, Bitcoin's price jumped by over 4%, reflecting the market's positive reception to regulatory clarity. However, while the current climate suggests potential for significant price increases, some analysts even speculate Bitcoin could reach $200,000 this year. Investors are advised to proceed with caution. The cryptocurrency market remains fraught with volatility, and external factors such as interest rates, inflation, and geopolitical tensions could heavily influence Bitcoin's trajectory. As the market digests these developments, the interplay of regulatory changes and macroeconomic conditions will be critical in shaping the future of Bitcoin and the digital currency landscape. As the crypto community continues to navigate these uncertain waters, the coming months will be pivotal. Will the anticipated regulatory frameworks provide the stability needed to foster further growth in the cryptocurrency space? Or will external pressures derail the bullish sentiment that has characterized the market? Only time will tell, but one thing is clear: the intersection of politics, regulation, and cryptocurrency is a dynamic arena that warrants close attention from investors and enthusiasts alike. In a striking turn of events, the political landscape in Washington is embracing cryptocurrency with an enthusiasm that echoes the earlier days of the tech boom. Following Donald Trump's recent presidential victory, the crypto market has witnessed a surge punctuated by a flurry of high-profile events, from black tie galas celebrating meme coins to a significant shift in regulatory sentiment towards digital assets. This evolution is not merely a reflection of changing political views, it has substantial implications for the financial landscape, particularly concerning Bitcoin and other cryptocurrencies. As Bitcoin approached the staggering price of $110,000, buoyed by speculation and strategic maneuvers by major figures like Elon Musk, concerns about a potential bubble began to emerge. Legendary Bitcoin trader voices have warned of a looming financial crisis, suggesting that the $4 trillion crypto market could be on the brink of a significant downturn. The risks associated with such a rapid rise cannot be underestimated, cautioned one analyst, highlighting the volatile nature of the current market. Adding to this narrative, Federal Reserve Chairman Jerome Powell recently opened the door for banks to offer Bitcoin and other cryptocurrencies, stating that they must ensure their services are safe and sound. This marks a notable departure from the previous administration's stance, which was characterized by skepticism and regulatory hurdles. Under Biden, crypto companies faced what many referred to as Operation Choke Point 2.0, a strategy that effectively cut off essential banking services for many in the industry. Powell's comments signal a new era of acceptance and integration of digital assets into the mainstream financial system. Trump's embrace of cryptocurrency is multifaceted, beginning with his foray into non-fungible tokens (NFTs) and culminating in the controversial launch of a Trump-branded memecoin. This trajectory has not only captured the attention of investors but has also led regulatory agencies to reconsider their previous opposition to the technology. As one industry insider noted, Trump's actions have led to a ripple effect, prompting regulators to rethink their approach to cryptocurrencies. However, this newfound optimism is tempered by concerns over Trump's broader economic policies, particularly his recent announcement of steep tariffs on imports from Canada, Mexico, and China. The tariffs, set at 25% for Canada and Mexico and 10% for China, have raised alarm bells about potential trade wars and their subsequent effects on the economy. Investor Robert Kiyosaki has voiced his apprehensions, predicting that such measures could lead to a crash in gold, silver, and Bitcoin prices. "Crashes mean assets are on sale," he remarked, indicating a belief that downturns could present buying opportunities for astute investors. As the political and financial spheres intertwine, the implications for the crypto market are profound. Wall Street is increasingly leaning into Bitcoin and crypto, with major asset managers like BlackRock leading the charge through the introduction of spot Bitcoin exchange-traded funds (ETFs). This normalization of digital assets within established financial frameworks could pave the way for broader acceptance and integration. Looking ahead, the trajectory of cryptocurrency under the Trump administration remains uncertain. While the current climate appears favorable for crypto enthusiasts, the potential for instability looms large amid geopolitical tensions and economic policies. The future will likely hinge on how effectively regulators can balance innovation with risk management, ensuring that the burgeoning crypto market can thrive without succumbing to the pitfalls of speculation. As the world watches, the interplay of politics and technology will define the next chapter of cryptocurrency's evolution. The cryptocurrency landscape is experiencing a seismic shift. As recent developments in U.S. politics and regulatory stances have stirred both excitement and trepidation among investors. Following Donald Trump's return to the political forefront with his presidential victory, the crypto market saw an initial surge, with Bitcoin peaking at nearly $110,000. However, fears of an impending market correction loom large, underscored by recent comments from Federal Reserve Chairman Jerome Powell and the specter of Trump's controversial economic policies. On February 2, 2025, Powell announced that U.S. banks are now permitted to engage with cryptocurrency, stating banks are perfectly able to serve crypto customers as long as they can understand and service the risks. His remarks signal a notable shift in regulatory sentiment, particularly in contrast to the previous Biden administration's strict stance, which many crypto firms likened to an effort to debank them, an initiative dubbed Operation Choke Point 2.0. This regulatory thaw is expected to encourage greater institutional participation in the crypto markets, particularly as Wall Street giants including BlackRock have begun to embrace Bitcoin and other cryptocurrencies through spot exchange-traded funds (ETFs). While Powell's comments may provide a glimmer of optimism, the market remains jittery. Trump's administration has already begun implementing steep tariffs on imports from Canada, Mexico, and China, raising concerns about a potential trade war and its ramifications on the broader economy. Renowned investor Robert Kiyosaki expressed his apprehension on social media, suggesting that the tariffs could precipitate a crash in gold, silver, and Bitcoin prices. Good. We'll buy more after prices crash. Real problem is debt, which will only get worse, he noted, indicating a belief that market corrections may present buying opportunities for savvy investors. In this context, the performance of major cryptocurrencies such as Bitcoin, Ethereum, and XRP has also come under scrutiny. As of the latest reports, Bitcoin has seen a 2.95% decline, trading at approximately $98,817, while Ethereum has dipped to around $3,063. XRP, despite a significant rally following Trump's election, is grappling with regulatory uncertainties that continue to cloud its future. The SEC's ongoing scrutiny of XRP as a potential security has left many investors wary, even as the token has reported gains of over 500% since the election. Ethereum, often regarded as a blue-chip cryptocurrency, has faced increasing competition from other blockchain platforms like Solana. Investors are concerned that Ethereum's performance has lagged behind Bitcoin, with recent data showing a mere 31% gain since the launch of spot ETFs, compared to Bitcoin's impressive 125% rise. Many are questioning whether Ethereum can maintain its market dominance amid emerging rivals. Chainlink, on the other hand, appears to be carving a niche for itself, leveraging its strengths in decentralized finance, DeFi, and real-world asset RWA tokenization. With a recent investment from Trump's administration, Chainlink is positioning itself as a key player in the burgeoning RWA market, which has the potential to transform traditional finance by digitizing assets on the blockchain. As the crypto market grapples with these dynamic shifts, investors are left contemplating the implications of regulatory changes and market volatility. The interplay between political developments, economic policies, and technological advancements will undoubtedly shape the future trajectory of cryptocurrencies. While there are concerns about a potential bubble burst, the evolving landscape also presents unique opportunities for those willing to navigate the complexities of this fast-paced market. The coming weeks and months will be critical as both new and seasoned investors assess their positions in a landscape that continues to redefine itself. As the cryptocurrency landscape evolves, the debate over which digital assets to invest in intensifies. With Bitcoin, the long-standing leader in the crypto market, facing a volatile trading environment, many investors are pondering whether it's time to pivot towards alternative options like Solana. Recent analyses reveal that Solana has outperformed Bitcoin significantly in the past 2 years, sparking discussions about its potential as a mainstream investment. In the last 2 years, Solana has surged by an astonishing 2,315%. while Bitcoin's increase stands at a more modest 533%. This disparity raises an important question: should investors forget Bitcoin and consider Solana instead? Proponents argue that Solana's rapid growth is supported by its foundational technology and expanding ecosystem, which includes decentralized finance, DeFi, non-fungible tokens, NFTs, and blockchain gaming. Solana's appeal lies not only in its performance metrics but also in its unique features. The platform is viewed as a potential Ethereum killer, offering faster transaction speeds and lower costs. Kathy Wood of ARK Invest has expressed optimism that Solana could eventually surpass Ethereum in the Layer 1 blockchain space. As of February 2, 2025, Solana's market capitalization is approximately $125 billion, with projections suggesting it could double if it captures significant market share from Ethereum, currently valued at around $380 billion. However, the current market conditions are challenging for Solana. Just as its price soared to a peak of $295.40 in mid-January, it has recently faced a steep decline, dropping to around $210. This downturn has been exacerbated by a broader crypto market sell-off, with Bitcoin briefly dipping below $100,000 and the total market capitalization of cryptocurrencies falling nearly 4% to $3.4 trillion. Despite these challenges, Solana's underlying fundamentals remain strong. The network saw record transaction volumes in January, surpassing $258 billion, and is on track to cross the $1 trillion milestone in total handled volume. The ecosystem is also witnessing an influx of new tokens and projects, including high-profile meme coins that have captured investor interest. Looking ahead, one of the most significant catalysts for Solana could be the approval of spot Solana exchange-traded funds ETFs in the United States. Analysts speculate that such approvals could bring in as much as $6 billion in new investments, making Solana as accessible as traditional tech stocks for retail investors. The potential approval aligns with a more crypto-friendly regulatory atmosphere under the new administration, which has raised hopes among investors. Additionally, investment firms like VanEck are projecting ambitious price targets for Solana, estimating it could reach as high as $3,200 by 2030 if it continues to gain market share from Ethereum. While these projections may seem optimistic, they underscore the growing confidence in Solana's long-term viability. In contrast, Bitcoin faces its own set of challenges. After a significant rally that saw it exceed $106,000, Bitcoin's price has fluctuated dramatically, influenced by macroeconomic factors and market sentiment. The volatile nature of the cryptocurrency market remains a concern, with investors closely monitoring developments from regulatory bodies and the global economic landscape. In conclusion, while Bitcoin continues to hold its ground as a leading cryptocurrency, Solana's meteoric rise presents a compelling alternative for investors seeking growth opportunities in the blockchain space. As the landscape evolves, it will be crucial for investors to stay informed about both assets' performance and the broader market dynamics. The coming months will likely reveal whether Solana can maintain its momentum and potentially redefine the cryptocurrency investment landscape.